A $100 payment erased $432. Not in a casino, not from a secret investment. On a plain 30-year mortgage, closed in March, one homeowner sent an extra $100 straight to principal and watched the lifetime interest bill drop by $432. That tiny move exposed something most borrowers never feel until too late. The first years of a mortgage are built to feed interest before freedom. Another person sent $600 extra and cut 3 months off the loan, plus $3,122 in interest. Someone else killed a mortgage 16 years early at age 62, then panicked because friends called it a mistake. This is the quiet race happening behind closed doors, where every extra dollar either buys back time or disappears into amortization. But the hardest question is brutal. Should you attack the mortgage or invest instead? For many households, the mortgage is not just another bill. It is the largest monthly weight on the budget, and it can last longer than entire careers. The promise sounds simple. Buy the home now, pay slowly for 30 years, and hope the income keeps showing up. But inside that promise is a cost most people underestimate, until the amortization schedule exposes it. Freedom has a number. A paid-off home means no monthly mortgage check, no lender standing between you and shelter, and a permanent drop in required expenses. That feels like an instant raise, because money once mailed away stays in your own life. But there is a conflict. Money used against a mortgage cannot be invested at the same time, unless income is high enough to do both. And a low 3.5% mortgage and a high 7% mortgage are not the same decision. That difference can change everything. One homeowner described the beginning of the fight with painful honesty. The loan was brand new. The term was 30 years. Yet, one extra $100 principal payment produced a projected $432 interest reduction. That is more than 4 times the cash sent in, created only because the payment hit principal early. This is why the first years matter. Mortgage payments are amortized, which means interest is calculated on the remaining balance. At the start, the balance is huge, so a large share of each payment goes to interest. Later, as the principal shrinks, more of the payment attacks the loan itself. The math is slow first, then it accelerates. That is the trap. Many homeowners will not keep the same house for the full 30-year term. People move, refinance, upgrade, downsize, divorce, lose jobs, change cities, and chase opportunity. So the loan structure collects more interest in the early years when the balance is highest. It is not magic. It is math working patiently against impatience. That is why extra principal payments can be so powerful near the beginning. They do not just reduce the balance. They reduce the future interest charged on that balance for years ahead. A small early hit can echo across decades. But motivation is where most plans collapse. Looking at a $400,000 mortgage can feel impossible. The number is too big to emotionally process, so the brain gives up before the budget even starts. One borrower solved that by cutting the mountain into 8 pieces. $50,000 times 8 equals $400,000. Each paid segment became a checkpoint, not a lifetime sentence. Milestones are fuel. After each $50,000 milestone, there could be a small reward, not a reckless one, a meal, a trip, or something symbolic enough to mark progress. The point was not luxury, it was proof. The borrower who paid off the house in 8 years and 8 months said the key was mindset. The result was $83,000 in interest saved. That is not just a payment plan. That is a psychological system. The mindset shift sounds simple, but it is not easy. Most people see extra mortgage payments as money leaving their life. A bonus arrives, and the instinct is to keep it liquid, spend it, or reward the grind. That reaction is human. You worked for the money, so sending it to a lender feels like losing cash. But the people racing toward payoff often see the same move differently. They are not buying less life now. They are buying more choices later. They are trading a temporary pile of cash for a permanent reduction in obligation. When the principal falls, the future becomes less fragile. That changes everything. This does not mean every windfall should be thrown at the mortgage. Essential bills must be current. High-interest credit cards should not be ignored, because a paid-down mortgage cannot buy groceries unless you borrow again. But once the financial floor is stable, extra principal becomes a tool for future flexibility. Another homeowner showed the numbers in real time. June was the first month of the mortgage payment. Before the extra payment, the principal balance stood at $213,190. A $600 bonus from a paycheck was sent directly to principal. After that single move, the new balance became $212,590. The projected result was 3 months cut from the loan and $3,122 in interest avoided. One payment, 3 months gone. That is why tracking matters. A spreadsheet or amortization calculator turns invisible progress into visible evidence. Without that feedback, $600 feels small against a six-figure loan. With the calculation, the borrower sees time disappear. 3 fewer months of debt is not abstract. It is a season of life taken back. Still, there is a dangerous oversimplification in the debt-free conversation. Paying off the mortgage early can be powerful, but it should not become a reason to ignore investing. One homeowner, who paid off a mortgage quickly, also invested at the same time, kept money in high-yield savings, and avoided turning the house into the only asset. That balance matters, because home equity is valuable, but it is not the same as liquid wealth. A house can make you rich on paper, while leaving you cash poor in real life. If every spare dollar goes into the walls, one emergency can force expensive borrowing. The goal is not just a paid-off house. The goal is financial recovery with options. That requires cash, investments, and lower debt working together. Even teachers are often found among millionaire professions, despite the common belief that they do not earn large incomes. That point is not about salary prestige. It is about behavior repeated for years. Living below your means, delaying gratification, investing steadily, and killing debt can beat flashy income with chaotic spending. Boring can become powerful. Then comes the case that makes the debate uncomfortable. A woman turned 62, and 2 weeks after her birthday, paid off her mortgage 16 years early. Instead of celebrating, she became terrified. Friends told her she had made the biggest financial mistake of her life, because her interest rate was only 3.5%. On paper, their argument had logic. If a mortgage costs 3.5% and investments might earn more, then paying it off early can look mathematically weaker. That argument becomes louder when markets offer long-term historical averages around 8% to 10% per year over the past 100 years. But no year is guaranteed. The spreadsheet says one thing, life may say another. Her life was not simple. She was single. She was in an 8-year cancer battle. Her doctor said she could not return to work for the foreseeable future. Her former employer disability benefit was $7,070 per month, and it would end in 3 years. She also expected about $3,000 per month from SSDI, after taxes and Medicare deductions. Then came the twist. She had not emptied herself. She had an $80,000 emergency fund in cash. She also had $23,000 set aside for insurance premiums expected to change in November. Her investments included $1,430,000 in a traditional IRA and $218,000 in a Roth. She began mentioning another $170,000 before the conversation shifted to fund quality. If invested well, those accounts were estimated to produce around $100,000 a year. In other words, she had killed the mortgage while still holding serious reserves and retirement assets. The fear was not math alone. It was uncertainty. Illness changes the meaning of risk. A mortgage payment that feels manageable at 40 can feel threatening at 62 when work is no longer available. Removing the house payment is not just a return calculation. It is stress reduction, survival planning, and control. This is where personal finance becomes personal. For someone young with stable income and a 3.5% mortgage, investing extra money may outperform early payoff over time. A taxable brokerage account invested in broad index funds, such as total market or S&P 500 style funds, can grow while the cheap mortgage remains fixed. Later, that account could be used to pay off the loan in one large move, if freedom becomes the priority. But a 7% mortgage changes the equation. Paying extra principal on that debt is like earning a guaranteed 7% by avoiding interest, before taxes or market risk. That guaranteed return can be hard to beat, especially when markets are uncertain. If rates ever dropped back toward 2.5% or 3%, refinancing could become a different conversation. But that may not happen soon. Numbers need context. The younger borrower with decades ahead may choose the investment route. Keep the low-rate mortgage, invest the extra cash, and let compounding work. If history rhymes, the brokerage account grows faster than the mortgage cost. At 50, or whenever early retirement becomes real, the investor can decide whether to liquidate part of the account and erase the mortgage, but that strategy demands discipline. Money in a brokerage account can be spent, mistimed, panic sold, or rated for lifestyle upgrades. Extra principal payments are harder to reverse, which is both weakness and strength. Illiquid equity can be inconvenient, but it also protects progress from impulse. The best strategy is not always the one with the highest expected return. It is the one a real person can follow during job loss, medical fear, market crashes, and family pressure. A perfect spreadsheet that collapses under stress is not a plan. It is decoration. The race to pay off mortgages is not only about interest. It is about removing a fixed claim on future income. Every principal payment lowers the balance. Every lower balance reduces future interest. Every avoided payment creates room for investing, medical costs, travel, generosity, or simply breathing easier. But the decision has layers. If the rate is low, cash reserves are thin, and investing has barely started, attacking the mortgage alone may create imbalance. If the rate is high, retirement is near, health is uncertain, or the payment feels dangerous, faster payoff may be worth more than a theoretical market edge. The rule is not always pay it off. The rule is not always invest instead. The real rule is sharper. Know your rate, know your timeline, know your liquidity, and know your nervous system. A $100 payment can save $432. A $600 payment can erase 3 months. A paid-off home can change a life, but only if the plan survives reality. The question is not whether debt freedom is beautiful. The question is whether you bought freedom or trapped every spare dollar inside the walls. Because a mortgage is not just a loan, it is a claim on the life you have not lived yet.